We're shifting from a seller's market toward a buyer's market. What we got a lot of lately are like just 8% below asking price offers.
It's been almost a mirror image from 6 months ago.
So how can sellers still make a profit by selling in this environment? Simple, provide more value.
We kind of had an example earlier today. A, it's a great cash flow play. B, some buyers are going to want to see some instant equity as well.
And that same seller also owned a property management company and he owned a renovation company. Like, go and sell my portfolio and I can also run renovations to increase value over time. In this type of market where it seems like there's a lot of doom and gloom in the air, it's actually an opportunity to make a huge impact, which is why I'm inviting you to listen to this episode of Inside SFR. Welcome to our next episode of Inside SFR. So, to your mind, what's changed? What can you tangibly say, like whether it's the last month or the last 3 months, the last 6 months, the last year, since you've been working in this space? You know, what's changed with this market?
Yeah, I'll take the first response on that. Pretty simple formula. As interest rates rise, borrowing money becomes more and more expensive. So the way institutional buyers really cope with that is they have to see a higher return and a higher yield. And so essentially in single-family rental space, that equates to a higher cap rate.
So it's not only that they need higher cap rates because their debt cost is higher, their view of where the market's going has actually changed. So like the big change that I saw is like the palpable need to deploy capital has basically gone away. Like it seemed like when things were going gangbusters, funds needed to spend money because people just wanted to get at this roller coaster ride. That was the residential housing market. Now it just seems like people are out there spending money and they're looking for good deals. Before, all you had to do was find a deal and price it correctly or price it realistically. Now you actually got to find good value in the deals, which very often means better cap rates. I think it means homes that have more embedded equity, being sold at some kind of discount to fair market value so that funds are incentivized to spend that money. Alan, you spend most of your time talking to buyers on the built for rent and SFR portfolio front. Do you feel that same change where firms are actually being a lot more particular about what they look at and what they spend money on?
Yeah, absolutely. I think the biggest change that I've noticed, 6 months ago before the interest rate hikes, our biggest obstacle was finding inventory. Now there's all these builders that are coming back to us saying, hey, can you move these new construction homes off our books? We're willing to take a discount to retail, anything that we can do to get a bulk transaction done. But a lot of the buyers, they've adjusted well to the interest rate environment. So they've huddled up internally. They've increased their investment metrics. Unfortunately, seller expectations haven't really caught up to that. They still think that they can put a price tag on anything and they're willing to achieve it. So really, the biggest obstacle on the build to rent side is managing seller expectations and letting them understand, hey, this is where the market's pricing your assets. Here's where we think we can trade your assets for. And if you're a willing seller at this price and at this cap rate, then yes, we can run a successful disposition.
Yeah, it's an interesting change, especially on the built for rent side, because you look at if you're a builder and now you're left holding some inventory you were expecting to move during the summer. Now it didn't move during the summer. Now we're going into the months of the winter where it's not necessarily the best time to sell. It's a scary time for a builder to be holding inventory. And on the flip side, like even if that's not true from the builder perspective, buyers think it's true. Buyers think that builders are going to be scared of holding excess inventory and they might be willing to sell at a steeper discount, which means what you end up getting is a lot of buyers just waiting for the deals that sometimes might happen or sometimes might not happen. And as a broker, when we're talking to sellers, it used to be, hey, just give us your pricing. Let's price it appropriately. We're going to move it. Now it's like, you got a great project. You got some great properties. You got to tell me what kind of value is in it for the buyers. Because while there's still buyers out there that are looking to deploy capital and spend their money, most that are out there are actually looking for good deals. So when we look for deals and talk to buyers, it's like, great, we got it priced appropriately, but where's the value?
And I'm seeing a lot of buyers being a lot more patient. There was a lot of competition before the interest rate hikes where they had to deploy capital. They had to get deals done. But now it's taken us longer to run dispositions and getting feedback. And a lot of these guys are still kind of playing the sidelines a little bit just to see how prices stabilize. So it's taken a little longer to get offers and good offers, which these sellers are not used to after the 2 years that they had.
And it always lags the market, right? So the buyers always make a shift, and then it takes sellers a little while to catch back up. And it's scary as a broker, right? Because we're trying to make deals happen in the middle here, and there's always, when markets shift, there's always this kind of dead time when buyers have changed their habits and sellers haven't gotten the message yet. And what you end up doing is just finding the sellers that really need to sell to make deals happen, and the rest just kind of like you said, everyone seems to be on the sidelines.
To add to that, Adam, I think that's really where we're able to provide value as brokers, because over the last month and a half, we've spent a lot of hours trying to talk to buyers, figure out where their heads are at, pretty much everyone in our network, so we have a better understanding of what they're looking for, why they're looking for it, and how we can adjust to set sellers' expectations appropriately to ultimately get deals done.
It's interesting you talk about like value as a broker, because when times are great as a broker, all you need to do is find inventory and it'll generally sell itself, right? Now it's like we got to actually look for value, and what you end up getting is saying no to lots of sellers that aren't really sellers in today's market. What we end up getting is a lot of inventory that we can't sell because it's overpriced or it's not priced to market, which just means the inventory that we do get ends up being, they're really sellers. Like they need to move the inventory, and I think we've done about as good a job as anyone in congealing this big buyer base where if you are a real seller and you're able to offer enough value to make the portfolio, if it's a portfolio or built for rent project, interesting, you're going to get traction. Like good deals are still good deals. It's just a matter of whether or not a seller is really a seller in this market, Second topic, in terms of like where pricing is right now versus where it was 3 months ago, 6 months ago, a year ago, a lot of SFR portfolio owners that haven't sold are trying to figure out what they lost, right? And where the market is right now and where it's heading. You guys talk to a lot of SFR portfolio owners. Your messaging has changed with those guys pretty dramatically over the last, few months, couple of quarters. Like, what was the conversation like a year ago, and what does it look like today?
I'd say 6 months to a year ago, we talked to a lot of sellers that kind of wanted to see what they could get for their portfolio. So we had to do some vetting on our end to see how legit of a seller they were, because we're throwing some good numbers that are at low cap rates out at them that we could get pretty close to, but if there were circumstances where we got the 95 to 97% of the asking price, and because we didn't get to 100%, they wouldn't sell. We learned a lot through that process, whereas right now we're seeing some different motivation for them in terms of they feel like they've left some money on the table, not selling over the last couple of months. And we've come to see that with the anticipation of a potential recession or continued increase in interest rates, if these portfolio owners are facing some sort of refinance in the next couple of years, they're either looking to sell or looking to refinance soon. So kind of understanding their motivation has been a big part of what we've been trying to do over the last couple of months.
So it's interesting. So like what I hear you saying is like before we had a lot of sellers that were like thinking about being sellers, and we used to come to them with like a price, and unless they got that price, they weren't sellers because they were sure the market was going to keep going up. Now it's like the real sellers are the ones that either they're retiring, they want to get out of property management, they want to reduce their risk, or they have a note coming due and they have to refinance, and that's going to take a hit to their cash flow, and they're real sellers. So like right now, I think we're still getting sellers that are just kind of wondering where they could sell at. The people that actually end up selling actually have a tangible motivation for selling. And I think the buyers are getting that message where like, unless a seller has a tangible motivation to sell, buyers don't get really excited about it unless there's like a story behind it. As opposed to before, it's like, just give us a product, we're going to bid on it no matter what. Any thoughts on it, Alan?
Yeah, I think, when things were going good, a lot of sellers were just kind of setting some unrealistic expectations. So why should I sell now if in 3 months my values are only going to get higher?
Yeah, 5% higher.
Exactly.
Yeah.
So when things are going good, a lot of people aren't expecting anything to stabilize for a while.
Yep.
So like Ian said, it's really tough to filter out who's a real buyer and at what price, especially with the market being so hot. I mean, you can't really blame them.
And we've seen across the board, like we come up with good portfolios and we set it to, our targeted group of buyers. And what we end up getting, what we got a lot of lately are like just like summary 20% below asking price offers. And it's kind of like, I was joking with one of our buyers, I won't say who they were. I started calling him 20% off just because I set him a portfolio. He got back to me right away, 20% off retail. It's like, so what you're saying to me is you're not really a buyer unless it's a smoking hot deal. But then it kind of draws attention to the buyers that are real buyers that take a deep dive on these properties and actually figure out like what a tangible value to the seller might be. And like it's pretty easy math. Like, if someone sells their portfolio of 50 properties retail, they're going to spend money doing it. They're going to rehab it. They're going to spend money on brokers, vacancy rate, pay taxes while it's vacant, closing cost. All of it amounts to disposition cost. And there's a number they're going to net at the end of that disposition process retail. It used to be like they had to get a premium to that number if they sold it as a portfolio. Now, I'm like, listen, if you get that number, it's a no-brainer, right? If you can get within like 5 to like 8% below that value, it's probably still a really good value for you because you're not going through that entire disposition process and all the headaches that come along with it. And if the market tends to slide or ends up sliding a little bit more, you're capturing that value. Yeah, you're paying for it, and you might feel like you're leaving some money on the table, but at the end of the day, you're getting rid of your portfolio in one swoop to one buyer, and you're de-risking yourself, and you're on to the next.
I'll say it's been interesting. You brought up the point of the 20% below automatic.
Yeah, like Snap.
Right. So it's been almost a mirror image from 6 months ago when we had sellers wanting to test what price they could get.
Yeah.
Now we have some buyers that are setting the
preliminary
offer that are doing the same thing on the opposite side. So.
Yep.
And you almost can't blame them for doing that, which is kind of brings me to this third topic, which is like what's a good value point for your sellers, right? And what's a good value point for your buyers? I talked a little bit about doing the math on what a seller might get net at the end of a retail process as being a good kind of like break-even point for what a good deal is for a buyer. But like to your mind, when you're talking to SFR portfolio owners or even build-for-rent sellers, like what are some other value points that you can kind of bring to a buyer that like kind of allow you to highlight tangible value? Obviously, pricing is one. Is there any other?
Yeah, no, that's a great question, and I think we kind of had an example earlier today. We were talking to an SFR portfolio owner where A, it's a great cash flow play. B, some buyers are going to want to see some instant equity as well. What's the retail value versus the delta versus the asking price, and can they, if they do make a competitive offer, are they going to see instant equity in a portfolio as long as cash flow, as long as appreciation? So there's different things other than just reaching a good asking price.
And that same seller also owned a property management company, and he owned a renovation company. So like one of the aspects of that particular seller was like, go and sell my portfolio, and I can manage this for any buyer that comes into the market, and I can also run renovations to increase value over time, right?
Right, and 6 months ago, it was the buyers that were being a lot more flexible in terms and conditions and what they can offer in terms of, working capital or EMD, but now it's flipped to the sellers that they're going to have to offer a little bit more than just a discount.
It's kind of like the buyers saying, like, times have changed. You need to offer me more value. Like, what is it? Pricing's a big part of that, but also these other ancillary things that sellers have are also a big part of it.
Exactly.
Yeah, and I would even, to add to that, I would say what current rents are versus market rents that you just touched on. If there's a big gap there, that provides some potential value, future value for a buyer.
Yep.
Additionally, to go along with that, that's really only valuable in the short term if a lot of the tenants are either month to month or their leases end, within the next 6 months. So we've come across a handful of portfolios that have leased out, most of the portfolio for, I'd say, Q3 or Q4 of 2023, which we've had some buyer feedback saying, hey, these are too far under market rent right now, and they're leased too far out in the future for us to want to take it on. So
yeah, and I think it boils down to buyers wanting to minimize as much risk as possible now, whether it's in the SFR world or the build to rent world. New construction, they don't want to put forward contracts out 18, 24 months out in advance anymore. They want to, close on stuff this year. They want to minimize their risk. They don't want to give out capital to builders so they can use it as pretty much a loan. So we're seeing a lot of those things that were making them more competitive 6 months ago. They're not offering the same terms anymore.
Yeah, it's funny. It's like, buyers tend to change their habits based upon not only their capital, but also where they think the market's going and what opportunities they think they might be able to get, 3 months, 6 months down the road. So at the same time that price numbers are coming out quarterly, and for the first time we're not seeing historic home price appreciation, obviously because retail buyers have higher interest rates. The idea that buyers just don't know what the market's going to look like in 3 months and 6 months. So they're trying to figure out where good deals are today. And on the built for rent side, it used to be we can sell a built for rent project that didn't have homes being completed for 18 to 24 months via forward contract. Now that's kind of shifted where buyers are saying, hey, we want you to send us portfolios of the last 20 or 30 properties in a subdivision because we feel like we can get better value there. Or we want homes that will be delivered before the first of next year because we don't know what the interest rate environment is going to be after the first month of next year. So it's not only where pricing is today and what inventory looks like, it's also what buyers think would happen or might happen. And they're trying to focus on things that are seemingly better opportunities today, so they can not go on a fishing expedition in getting under contract with things that might not look like a great deal tomorrow.
Yeah, and it's so tough to kind of forecast cost of capital now. So they only want to put things under contract where they can probably close this year, or if they are willing to take on a little more risk, I don't know, maybe 12 months out tops. Whereas we've had opportunities from a developer where it's pretty much raw land now, and we were able to get forward contracts 18, 24 months out.
It's funny, we went to a conference recently and people talked a lot about getting back to fundamentals. With build for rent, pricing got so wacky for a little bit that people forgot about the fundamental truth, which is when you buy raw land, you put a certain amount of money into that raw land to get it to be fully approved entitled lots. And there's a profit margin there that got way out of whack because people were paying extraordinary prices for the end products. And they were willing to pay up for the land. And that kind of got builders to the point where we saw more deals that were land deals where they were offering the land at an inflated price where they were making hundreds of percent, maybe thousands of percent on their investment in the land just because they know they can sell the finished homes at the end of the day for a much lower cap rate. Now it's getting back to fundamentals. Price of the land has to be appropriate. The costs that are coming up with to develop that land have to be really, really dialed in. And the finished lot cost has to make a lot of sense as a percentage of the home value at the end of the day. So when you look at all these things, this is kind of the way it always should have been, absent of this craziness that happened over the last 3 years. And a lot of sellers are now getting the picture that, oh, geez, we got to start sharpening our pencils back to the way we used to do it in 2014, 2015 in order to make deals happen right now, because pricing these portfolios at higher than retail values into a cap rate that was, 5 months ago, 6 months ago, a year ago isn't working anymore.
Yeah, and it's interesting because I believe we're having to adjust our underwriting because we, over the last 2 years, we've, for product that's being built 6 months, 12 months down the road, we're having to add in some sort of housing premium or pricing premium to what the finished units are going to be at that time. So underwriting has adjusted accordingly.
Yeah, and we're not doing that anymore. It used to be we priced it to today's values, and we had to forecast what the appreciation was so we can kind of try to price the properties that are going to be delivered in 12 months at tomorrow's value. Now the buyers just aren't willing to pay for it. Some of them are asking for a rebate because they don't know what's going to happen during that time. So the house is worth $300,000 today, and a year ago we might have thought it would be worth $320,000 in 12 months, right? Now it's we're having a hard time selling it for $300,000 because the buyer's saying, hey, we don't know what's going to happen. We don't want to pay today's values. We want some kind of discount to today's values. And that is a jarring change to any builder, when they go down the retail route versus looking at what institutional buyers will buy. It's going to take, I think, a quarter or two of really scary numbers on the home price front to have builders and build for rent suppliers really look at the number they can get from an institutional investor and think, is de-risking myself to the extent I can de-risk myself by selling to an institutional buyer really worth that kind of haircut? And I don't know that a lot of them will, but some of them might end up holding it and trying to go retail. And, if they can't sell it retail, end up selling it for the discount that they're being offered today. Some of them might just say, hey, screw it. I can make good profit doing it today. I'll take the deal that's in front of me right now.
And I think to touch on the other side of the underwriting too, I spoke to a lot of buyers at our recent conference. And when the market was so hot, they were underwriting rents for their hold period, and they were adding, ridiculous premiums year after year, 10, 15, 20% rent growth in certain markets, which is obviously not going to be sustainable over a hold period. So they've had to dial back on their modeling, which has adjusted their offer prices. So it's really just, buyers sharpening their pencils on the underwriting, us having to, understand how they're underwriting to manage our seller expectations. So it's definitely been a learning process.
Yeah. So taking this out, I don't want to make it seem like this is all doom and gloom. This is actually a very healthy thing, I think, for the real estate market. It's great for brokers because I think it's going to end up ferrying out brokers that haven't been in this for a long time and just kind of plowed into the market, trying to capitalize on this rapid expansion of home prices and the build for rent trend. I think what we're going to end up seeing is people going to other industries that are not going to be able to adjust to this market condition, which means good brokers are going to have a good time over the next few years, as long as they do a lot of the things we just talked about, which is setting sell expectations correctly, setting pricing correctly, really finding out what buyers want and delivering it. So it's not all doom and gloom. I think it's going to be an exciting time in the SFR business over the next 12 to 24 months for people that really understand the market and people that really understand the asset class.
Yeah, and I think it just boils down to the fundamentals. There's still a lack of inventory in housing. Builders are still going to build houses. Unfortunately, maybe the retail route is not going to be as appealing as it once was. So they're going to have to adjust and they're going to have to pivot. And we're seeing a lot more uptick in inventory. So as long as we're able to price it correctly, run a successful disposition, I think I'm very bullish on build to rent. So I think it's here to stay for the foreseeable future.
Good stuff. Hopefully you found this interesting and we get some good insight into the single family rental industry and sector. If you want to find us, we're on all the major podcast platforms. Check us out. Thanks a lot for listening.